Silver consolidation trap, 30%, up or down? The break. No one sees coming silver is frozen in the perfect trap. Everyone's watching the same price, but nobody's seeing what's happening beneath it. This is OG John AG, and what I'm about to show you will change how you view this market forever. The consolidation you're watching isn't balance, it's a loaded spring. Right now, silver sits exactly 30% up from recent lows and 30% down from recent highs. Bulls think they're winning, bears think they're controlling, but both sides are being played. While traders argue over charts, the physical market just sent a signal that can't be ignored. Something broke last week that Wall Street hoped you'd never notice. The numbers I'm about to share are verified, documented, and deeply disturbing for anyone holding paper positions. Let me get one thing straight before we dive deeper. I'm not here to sell you hopium or fear. Current silver prices, as of this recording. Western spot sitting at 32.15, futures at 32.20, Shanghai spot at 33.80, Shanghai futures at 34.10. That's a 190 premium that's been locked in for weeks now, and it's not shrinking. When Eastern markets consistently pay nearly 6% more for the same metal, that's not noise, that's structural divergence screaming at you. The COMEX registered silver inventory just did something it hasn't done in 15 years. Total registered dropped to 96.8 million ounces after a single-day drain of 6.2 million ounces. March contract open interest is holding at 68,000 contracts, which represents 340 million ounces of paper claims against less than 97 million ounces of actual deliverable metal. Do the math yourself. That's a 3.5 to 1 ratio of promises versus reality. First notice day hits February 28th, which gives us exactly 16 days before this gets tested. Now here's what most analysts are missing while they draw pretty lines on charts. Silver rallied from approximately $64.50 to $34 over the past months. That's your 30% move up. Then it corrected back to current levels around $32, roughly 30% down from the peak. Every trader got their moment of validation, bulls had their run, bears had their correction, and now both camps are convinced they're right. This equilibrium is the most dangerous setup in modern commodity markets. While everyone debates direction, physical silver is disappearing from vaults at an accelerating rate. The Silver Institute published their annual forecast 3 days ago, and the numbers are absolutely shocking if you know how to read between the lines. 6 consecutive years of structural deficit. Not projected, confirmed. The 2025 deficit is forecasted at 71 million ounces, which means more silver will be consumed than mined for the 6th year running. Investment demand jumped 24% to 241 million ounces, the highest level in 4 years and still climbing. India's silver imports are projected to hit 235 million ounces this year alone. To put that in perspective, that's roughly 27% of total global annual mine production going into one country. China's imports aren't slowing either. They're accelerating despite the trade tensions and economic headwinds everyone keeps talking about. Industrial demand is forecast at 667 million ounces. And yes, it's down slightly from last year due to solar panel efficiency improvements. But here's what they're not telling you. Solar manufacturers are building inventory ahead of expected shortages. Mine production is expected to increase by just 1.2% to 827 million ounces globally. Recycling jumped 9% to cross 208 million ounces for the first time since 2011. Even with maximum recycling efforts and modest mine production increases, the market still faces a 71 million ounce deficit. That's cumulative drain happening year after year, pulling from above ground stockpiles that are already critically low. Now let me show you the geopolitical chess game happening in plain sight. China's total holdings of U.S. treasuries, stocks, and bonds dropped to $1.52 trillion, the lowest level in 15 years. When you exclude custodial accounts held through Belgium, which most analysts believe are Chinese assets, the real number drops to $1.13 trillion, levels not seen since 2007. China's official treasury holdings fell another $7.3 billion in December to $674.8 billion. Beijing isn't just selling treasuries randomly, they're actively instructing state banks to accelerate U.S. debt sales. This is documented policy, not speculation, and it's happening while precious metals imports surge. Connect the dots, because these aren't isolated events. When the world's largest foreign creditor systematically exits dollar-denominated assets over 15 years, the capital goes somewhere. It flows into commodities, infrastructure, strategic materials, and physical assets that hold value regardless of currency manipulation. The World Uncertainty Index just hit 47,800 points, surpassing 2020 pandemic peaks and 2008 financial crisis levels. We are living through the most economically uncertain period in recorded modern history, according to quantifiable metrics. Jesse Livermore understood this pattern over a century ago when he wrote about distinguishing real bull markets from bear market rallies. He said the big money isn't made in the daily noise, it's made in the major trend that most people recognize too late. The multi-year silver deficit, combined with global de-dollarization and strategic reserve building, is that major trend. Most investors will miss it entirely because they're waiting for CNBC to confirm it after the move is already finished. Here's the timing trap that's about to get exploited. Shanghai Metals Exchange closes Sunday, February 16th through Tuesday, February 25th for Chinese New Year celebrations. That's 9 full days where the largest physical silver market in the world goes completely dark. Western bullion banks know this pattern intimately. When Shanghai buyers disappear temporarily, there's no physical bid to absorb selling pressure. Historically, expect aggressive paper selling and price manipulation during exactly this window. Check the data from the last 5 Chinese New Year closures if you doubt this pattern. But here's what makes 2025 different from previous years. China's silver market entered record backwardation 3 weeks before the holiday shutdown. The front-month Shanghai contract is trading at the highest premium over deferred contracts in exchange history. That extreme backwardation signals one thing clearly: inventory crisis. When buyers are paying massive premiums for immediate delivery versus future delivery, physical metal is scarce right now. Short sellers on Shanghai are paying penalty fees just to delay delivery obligations. That's not normal market behavior. That's shortage mechanics. Now let me show you the macro disconnect that's setting up the perfect storm. The job openings to unemployment ratio just turned negative for the first time since 2020. When openings fall faster than unemployment rises, layoffs are coming whether anyone admits it or not. 12 major U.S. corporations filed Chapter 11 bankruptcy in the last 8 days alone. Corporate bankruptcy filings are running at the highest pace since COVID lockdowns. Consumer debt defaults crossed 5.1%, the highest level in 9 years and accelerating. Employment is weakening, corporate failures are mounting, consumer defaults are spiking, yet silver is up 27% year to date and gold is up 18%. This isn't an economic recovery, this is currency debasement colliding with supply constraints while the real economy crumbles. Ray Dalio documented this exact pattern in his book on navigating debt crises. He explained how debt cycles don't end with sudden dramatic collapse. They end with gradual currency devaluation that makes debts technically serviceable while destroying the purchasing power of everyone holding cash. We're watching that exact playbook unfold in real time right now. Here's the development that changes everything at the institutional level. Texas announced last week they're producing state-minted gold and silver coins approved for IRA and 401k holdings for state residents. The initial batch will be commemorative, but production is scaling for mass retirement account adoption. Scottsdale Mint is handling production and distribution infrastructure. This is the first domino. When one state successfully creates precious metals, access for retirement accounts. Others will follow immediately. Florida, Wyoming, Montana, and South Dakota are already drafting similar legislation. When individual states mint their own coins with retirement account approval, you're creating massive institutional demand infrastructure. If Texas succeeds and just 10 states follow with similar programs, you're talking about hundreds of millions of retirement accounts gaining approved access to physical precious metals. That creates permanent structural bid from the largest pool of investable capital in America. Morgan Stanley released rare earth projections yesterday that most people scrolled past without understanding the implications. Rare earth magnet demand could increase 485 times over the next 25 years, driven by electric vehicles, wind turbines, military applications, and technology infrastructure. China currently produces 92% of global rare earth magnets and has explicitly stated they'll use this dominance as geopolitical leverage. When commodity exchanges launch futures contracts for strategically critical materials, that's institutional acknowledgement that supply chains matter. It's also setting up the exact same paper manipulation dynamics that have plagued precious metals for decades. Physical shortage meets paper abundance until the divergence breaks violently. The COMEX drainage accelerated dramatically this week. Nearly 6.2 million ounces drained in a single session, with 2.8 million withdrawn from JP Morgan vaults alone. Goldman Sachs withdrew 1.4 million ounces, and HSBC pulled 1.1 million ounces in the same day. Total COMEX registered silver fell to 96.8 million ounces, while March open interest holds at 68,000 contracts. That's 340 million ounces of paper obligations against 96.8 million ounces of registered physical metal. February deliveries already exceeded 110% of initial open interest. Contracts that were supposed to settle in cash ended up demanding physical delivery. If March follows anywhere close to February's delivery patterns, COMEX faces the largest physical delivery stress test in modern commodity exchange history. Note that approximately 3,200 contracts rolled from March to May, but March open interest still sits at 68,000, representing 340 million ounces. SLV experienced massive net selling on February 2nd that exactly offset all January inflows. Stop losses were systematically hunted and triggered in the coordinated waterfall decline. Price stopped falling exactly at monthly support levels. This wasn't random selling, this was engineered month-end contract settlement. However, physical silver flowed back into SLV immediately after the crash, and vault inventory problems intensified despite lower prices. Bullion banks face an impossible choice now. Either they buy back SLV shares and redeem baskets for physical delivery, which pushes spot prices higher, or they buy back COMEX futures to net out positions and avoid deliveries, which also pushes prices higher. Both paths lead to the same outcome, and time is running out with first notice day 16 days away. Here's the bearish case, because intellectual honesty demands we examine both sides. March 1st, notice day is 2 weeks away. The contracts can roll to May or July to avoid delivery. Cash settlement can be enforced under exchange rules if delivery defaults occur. The system has more escape mechanisms than most retail traders realize. Shanghai closes, creating a 9-day manipulation window where Eastern physical buyers disappear. Without Chinese buying pressure, Western banks can orchestrate sharp temporary declines. The 150-period exponential moving average on the 4-hour chart just broke as resistance. Technical structure could deteriorate further before delivery pressure forces the issue. Corporate bankruptcies are elevated, but not catastrophic yet. We're not in 2008 level crisis territory. Consumer defaults are high, but not systemic. The economy could muddle through stagflation for years without triggering the crisis everyone expects. Paper price manipulation has persisted for decades, despite recurring physical tightness. The establishment has contained these situations repeatedly through creative accounting and rule changes. Technical traders watching the 150 EMA breakdown have legitimate reasons for caution until that level gets reclaimed with conviction. Short-term price action could remain choppy and frustrating for weeks or months. But now, let me show you the other side of this equation that overwhelms the bearish case. February deliveries exceeded 110% of initial open interest. That's unprecedented demand for physical settlement. March sits at 340 million ounces of paper claims, with first notice approaching against 96.8 million registered physical. India is importing 27% of global annual mine production into one country. 6 consecutive years of structural deficit, with 71 million ounce shortfall confirmed for 2025. Investment demand surged 24% to 241 million ounces and accelerating. China is in record backwardation, paying premium fees just to delay deliveries they can't fulfill. Shanghai premium holds steady at $1.90 per ounce despite arbitrage opportunities. These are documented verifiable data points from Silver Institute reports, COMEX warehouse statistics, Shanghai futures exchange data, state government announcements, and investment bank research. The people who verify independently understand this isn't hype or speculation. It's structural pressure building across multiple vectors simultaneously. Here's what matters for the next 30 days specifically. February 28th marks first notice day for March contracts. That's when delivery intentions must be declared. March open interest represents 68,000 contracts, or 340 million ounces, against 96.8 million registered. Shanghai closes February 16th through 25th, creating a 9-day manipulation window. China already entered record backwardation before the closure. The $1.90 sustained premium between East and West isn't closing despite massive arbitrage opportunity. India's import surge continues unabated regardless of price fluctuations. 6 consecutive deficit years, confirmed with industrial demand holding despite solar efficiency improvements. COMEX registered inventory fell below 97 million ounces for the first time in modern tracking history. Watch what happens during the Chinese New Year closure window. Watch delivery intentions leading into February 28th first notice. Watch whether the 150 EMA gets reclaimed with volume or continues acting as resistance. Watch Shanghai premium when markets reopen February 26th. If it widens further, physical shortages intensifying. Watch March contract behavior. Does it roll to avoid delivery or stand for physical metal? Technical analysis suggests caution and potential downside. Fundamental analysis suggests accumulation during weakness. Geopolitical analysis suggests accelerating de-dollarization and strategic reserve building. Timing analysis shows 16 days until March delivery test with Shanghai dark for 9 of those days. Silver Institute reports are publicly available for verification. COMEX data updates every business day on exchange websites. Shanghai Premium is posted on futures exchange platforms in real time. Texas state mint announcements are documented in official legislation. Morgan Stanley rare earth projections are published research available to anyone. China's treasury sales are reported monthly by the U.S. Treasury Department. Verify every single claim independently because your capital depends on accuracy, not hope. The investors who do the homework understand why delivery ratios matter when paper claims exceed physical by 3.5 to 1. They recognize what persistent premiums signal when arbitrage opportunities won't close despite billions in potential profit. They understand why backwardation matters when the largest physical market pays penalties to avoid deliveries. This consolidation isn't balance, it's compression before violent expansion in one direction. The break is coming whether anyone sees it or not, and 30% moves in either direction are mathematically guaranteed when this spring releases. Most traders will be positioned wrong when it happens because they're watching price instead of inventory. They're following technical patterns instead of physical flows. They're trusting paper markets instead of verifying vault data. The smart money is already positioned because they saw this setup building for 6 consecutive deficit years. They understood what it meant when China entered record backwardation. They recognized the significance when COMEX registered fell below 97 million ounces. They calculated the math when March open interest represented 3.5 times available physical metal. The question isn't if this consolidation breaks. The question is which direction when physical reality overwhelms paper fiction. Technical traders expecting lower prices might be right for 2 weeks during Shanghai closure. Fundamental investors expecting higher prices are right for the multi-year trend. Both can be correct on different time frames, but only one side survives when delivery day forces settlement. Watch the March contract like your portfolio depends on it, because it does. Watch Shanghai Premium when markets reopen. That's your real-time shortage indicator. Watch COMEX inventory daily, because every million ounces that drains increases delivery pressure exponentially. Watch state-level precious metals adoption, because institutional access creates permanent demand infrastructure. This isn't a trade signal or financial advice. This is market structure education showing you what's building beneath price consolidation. Verify independently, protect your capital first, understand your time frame, and respect risk above opportunity. The consolidation trap is set. The break nobody sees coming is already in motion beneath the surface. Your capital, your decisions, your responsibility. Invest with verified data, not hopium or hype. The 30% move is guaranteed by mathematics. The direction reveals itself to those watching physical flows instead of paper charts. 16 days until March delivery test begins. The smart money already knows which side of this trade survives what's coming. Everything I've shown you today is verifiable through public sources that anyone can access. The Silver Institute publishes comprehensive annual outlooks with detailed supply and demand forecasts. COMEX releases daily warehouse stock reports showing every ounce that enters or exits registered inventory. Shanghai Futures Exchange posts real-time premium data revealing Eastern market dynamics. U.S. Treasury Department publishes monthly reports on foreign holdings of American debt securities. State legislatures publish official announcements about precious metals programs and retirement account regulations. Investment banks release detailed research reports on strategic materials. Exchange-traded funds like SLV report daily inventory changes. Every data point exists in the public domain waiting for verification. The difference between retail traders and institutional players isn't access to information, it's willingness to verify independently. Most people would rather watch videos than check COMEX warehouse reports, and that laziness costs them when markets move. The consolidation you're watching right now represents the calm before one of the most significant commodity market moves in modern history. Every structural indicator points clearly to the same conclusion. Physical silver is disappearing faster than it can be replaced. Paper markets are currently pretending this doesn't matter until delivery day forces reality into the open. Watch the data, verify the sources, understand the time frames, and protect your capital above all else. The consolidation trap is set, the break is coming, and 16 days separate speculation from reality. Your capital, your verification, your responsibility, invest with knowledge, not hope.